Hello, everybody. Welcome. Well, we are just super excited to be here and to build on Yuman's talk about what are the right metrics for customer success. We're going to talk about what are the metrics that investors care about. And with me is Chelsea Stoner, the general partner at Battery, one of the top investment firms out there, top quartile consistently. She's been investing in the space for about 17 years behind like Avalara, Intact, and other companies that are focused on the office of the CFO. And she's the idea behind bringing SaaStr and Chargeify together, which became Maxio. So Maxio is a billing and subscription management financial operations platform, and I'm CEO, been there about a year. So the state of B2B subscription growth, a couple of things. One, everyone's been talking about it. The world has changed, valuations are going down. If you look at the trends in the public companies, 2023 is significantly lower at 5x. You all who've been around for a while know it used to be crazy high, 20, 30x. I mean, I've been in the space for about 23 years and watched it pop and drop over that whole time. This is a 75% decline from the average valuation seen in 2021. So if you take the public company, you can track that. At Maxio, we have 2,300 companies. We are the system of record for billing and invoicing. That means we know what's really going on. Jason Lemkin actually shared this at his keynote earlier. That bottom line is what we've seen across our private company growth. And this is thanks to a good friend of ours, David Spitz, who put this together for us. And then in the Maxio Institute report, which there are going to be copies in the back if you want, which gets into the next level of detail, we outline what the growth trends have been in private companies. Private companies about $1 million to maybe $50, $60 million. Again, the N is 2,000. What you've seen is in Q1 2022, it was the heady days, 30% year-over-year growth. In Q1 of this year, it dropped to 15% across the entire segment. And what we're talking about is, hey, Q2 2023, you see a little bit of a dip, a little bit of a turn. Has it bottomed out? I don't know, but stand by. Q3 will come out with another report and we'll tell you what's happening.
We think so. We think it's...
Yeah, what are you seeing?
Yeah, that's exactly what we're seeing. We're seeing kind of the moderation now. It decelerated very quickly, as we all know. And we are seeing flattening out throughout the portfolio.
Cool. So one of the ways we split the data is we look at it by size of company and stage of company. And so Chelsea, when we look at this and we see the decreasing growth rate in the smaller companies between sort of 1 and 2 million, and then you see really 0 to 1 million, as an investor, what strikes you with that?
Yeah, I mean, look, anything kind of less than 2 million, we always are wondering if they've found product market fit, right? And so this kind of suggests that this is on average, right? But a number of these companies probably are having a hard time with product market fit.
And what we were talking about earlier is Battery sees 5,000 pitches a year. They only invest in 20 or 25 a year. So you get a lot of exposure to the broad set of customers. And when we showed this split by pre-Series A and Series A, and you're seeing growth rates at 20%, like, is everybody having that issue?
No, I mean, that's a good question. So the question is, for folks familiar with T2D3, my partner Neeraj Agarwal coined the phrase many years ago, probably 8 years ago now. What we see is some of the most successful companies follow the T2D3 path, which is triple. Once you hit 2 million of revenue, you found the product market fit, and you're scaling, you're tripling to 6, to 18, and then doubling after that. During the period of free money that we just came out of the last few years, what we were seeing was actually 5x. Instead of just a triple, the best companies were actually 5xing because they were spending for growth, right? We are seeing T2D3. We are funding those companies, so it still does exist, even though we don't have free money for growth. So it's still a pretty good model.
Yeah, and for those companies in that Series A, when we were chatting a little bit earlier, you're like, well, if they're really not tracking on that T2D3, they're not going to get past your initial screen. And some of your advice for them about, like, take a deep, hard look at your product market fit.
That was my big question mark looking at the Series A here. And again, this is an average across 2,000 companies, so it's kind of hard to pull out. I'm sure there's some really great ones and some that maybe are struggling a bit. But this is quarterly growth. So if you're on that T2D3 path, we should see kind of north of 30%, right, on quarterly growth. And I think it's 11% if you look at the actual numbers. And so that's a sign that there's some product market fit issues, I'd say.
And so when you and your team, your investment team, is looking at these different investments, we talked about there being there's so many operating metrics and SaaS metrics, you get overwhelmed with it, but at the end of the day, in this situation where there's a recession in the tech, what are the three things that you're looking at, and how do you think about the priority?
Yeah, so the beauty of SaaS, of the model, is that there are so many metrics, as you said, that you can use to compare and contrast across companies. It's really hard to pick just three, but we're looking as investors at all of these metrics as signals, right? First, for product market fit, partnered with all of our market research and qualitative analysis that we do. And then finally, once we know that product market fit is there, do you have the metrics for scale to become a sizable, profitable company? We look at unit economics. So it's hard to boil everything that we look at down to three core ones, but I'd say these are kind of fundamentally, I've been doing this for 17 years, like Randy said, and these are the ones that persist and really are a predictor of long-term success. I think everybody knows that we have all of them as ones.
All of them are all ranked equally important.
Number one. In this period of free money that we're just coming out of, ARR growth rate was by far the biggest, the one that everybody really focused on, the one that valuations were being based on. I would put that as 3. That's still a very big metric that we focus on. It's the number one predictor of product market fit in the early stages. As long as you have good unit economics, right, and you're not just giving your product away, which a lot of companies were actually doing, interestingly. So that's still a really big one that we focus on. The next, I'd say, the burn rate efficiency. I love this metric because it encapsulates not just your growth, what you're spending on growth, but actually your full unit economics, right? You're going to have different burn rate efficiencies based on your scale. And so you would, smaller companies, because you have more fixed costs early on, you're going to have a higher burn rate. We like to see generally something less than 1.5. The best that I've ever seen is a vertical SaaS company that built a $120 million ARR business on just $2 million of cash. Awesome company, but that gives you a sense. It can be done efficiently. And then finally, and we just heard from the Churn Zero folks, gross retention rate. This is probably the best predictor of a successful long-term business over time, and really the highest correlation for valuation. If you look at the public markets as well, that's true. So we focus a lot of time on gross retention rate. It helps us determine if you have a need to have versus just a nice to have product. We generally, kind of good here would be 90% plus. Great would be 95% plus. That's really for mission critical applications, ERP type products. But anything less than 90%, it doesn't mean that that's not something that's investable. It just really makes us kind of peel back the onion and understand what's going on there. Like, what Churn Zero was saying, do you have customer success issues, or is it a product issue? And so we're going to spend a lot of time, because less than 90%, you start to get that leaky bucket when you scale that really doesn't help you grow. So
yeah, just building on that, at our last board meeting, we were sitting around, we were talking about potential partners that we might want to get closer to, and Chelsea and the other chairman of the board said, Randy, if they're less than 92%, I've got a red flag, and you got to prove why this is a great company to be looking at. I was like, 92? I thought we were talking about 90. And he said, no, because you're going to dig in and you're going to find some stuff. So I think really what's interesting, both in terms of acquisition, but also for funding in this environment, that 92%, if you don't have it, you got to go look at the product market fit. You got to look how you take care of your customers, like Umon and team talked about. The other metric I would just offer is on this burn rate efficiency. This was new to me. The last company I ran and sold was VC-backed, top syndicate, and it was all about growth. And burn was like, I don't know, go spend more money, right? Working with Battery, they brought this discipline of, look, if you're not going to be profitable, like, what is your metric here? How are you doing on your burn? And I thought it was a really great way to net it out in terms of what are you spending and what are you getting for it. So again, in this day and age of efficient growth,
that's where it's at.
The things have changed. So I would say from the winners that Battery and Chelsea see, there are really 3 things to think about. One is prove you have product market fit. This is a focus on net ARR growth rate. Are people willing to buy what you've got? You're actually paying money for it, and it works on a unit cost economic basis. Number 2 is embrace disciplined growth on the way to weather the downturn. And this is all about burn rate efficiency. Growth at all costs, disciplined growth. And the third thing is understand retaining customers is the ultimate mark of a sustainable business. You heard Churn Zero talk about it. You hear us talk about it. Everybody out there is going to talk about gross retention. And so that's it. That's our 10 minutes. We've got the Maxio Institute Growth Report. People in this really cool blue shirt can hand out to you. And then written about investor metrics on LinkedIn if you wanted to connect with me and read more about how Battery approaches their investments and how they manage people like me. Thank you all. Have a great day.